November 3, 1907. A Sunday evening in Manhattan. The most powerful banker in America sends urgent messages to every trust company president in the city. The summons is simple: come to my library now. When they arrive, Morgan quietly locks the front doors. No one leaves until this is solved. Here is the paradox that defines this story. When John D. Rockefeller built Standard Oil, he accumulated a fortune worth $400 billion in today's money. When J.P. Morgan died, 6 years after that night in his library, his estate was valued at approximately $80 million. Upon hearing the news, Rockefeller reportedly said, "And to think he was not even a rich man." Yet, on that November night, Morgan did something Rockefeller never could. He stopped a financial panic that was destroying the American economy, not through his wealth, but through his influence. In 1907, America had no central bank, no Federal Reserve, no government mechanism to stop a cascading financial collapse. There was only one man with enough control over enough institutions to coordinate a response, and he had just locked 40 bankers in a room. This is the story of how one banker accumulated not wealth, but something more valuable. Control over the machinery of American capitalism itself. The system he built was called Reorganization, and by dawn, it would rewrite the rules of American finance. To understand how Morgan became the private lender of last resort for an entire nation, you have to understand what he built in the decades before that night. It started with railroads, and it started with chaos. In the 1880s, America's railroad system was a disaster. Dozens of competing lines ran parallel routes, undercutting each other on freight rates until no one made money. Bankruptcies came every few years like clockwork. The cycle was predictable: build too much track, slash prices, collapse, reorganize, repeat. The problem was not just American. Investors in London, Paris, and Frankfurt had poured fortunes into American rail bonds. When those bonds defaulted, European banking houses lost millions. They needed someone on the ground who could fix their investments, someone who understood both American industry and European capital. Morgan's father, Junius, had built exactly those relationships. He ran a banking house in London with deep connections to continental finance. When European investors needed someone to restructure their failing American railroads, they turned to the Morgan family. And J.P. Morgan developed a brutal, systematic approach to the problem, a method so consistent that the industry gave it a name: Morganization. The process followed a precise pattern. First, acquire control of a bankrupt railroad through its bondholders. Second, replace the entire board of directors with men loyal to Morgan. Third, end the destructive price wars by negotiating rate agreements with competitors. Fourth, merge the strongest lines into consolidated regional systems. Fifth, install professional managers who reported to Morgan's network. The result was efficiency, order from chaos, predictable returns for investors, and board seats for Morgan's allies across the railroad industry. In 1885, he reorganized the New York Central after a bruising fight with rival financiers. In 1886, the Philadelphia and Reading. In 1888, the Chesapeake and Ohio. Each intervention strengthened his network. Each new board seat extended his reach. But the real acceleration came with the crash of 1893. That year, banks failed across the country. Railroads that had seemed stable months earlier suddenly could not pay their debts. The Richmond and Danville Railroad collapsed. The East Tennessee, Virginia, and Georgia Railroad went bankrupt. The Northern Pacific, one of the great transcontinental lines, defaulted on its bonds. For most investors, this was catastrophe. For Morgan, it was opportunity. In 1894, he, He consolidated the Richmond and Danville with the East Tennessee, Virginia, and Georgia to form the Southern Railway. One stroke, two failed railroads became one functional system under Morgan's control. In 1897, he reorganized the Northern Pacific after its bankruptcy. The bondholders took losses. The shareholders were wiped out, but the railroad survived, and Morgan's representatives joined its board. By 1900, Morgan interests controlled approximately 1/6 of America's railroad mileage, not through ownership. Morgan did not need to own the stock. He controlled the boards, he controlled the financing, he controlled who got credit and who got cut off. This was the architecture of influence. Morgan understood something his rivals missed, that in a complex economy, the power to coordinate matters more than the power to own. If you sit on enough boards, if you control enough credit relationships, if you can call a meeting and have everyone show up, you do not need to own anything. You just need to be the person everyone else needs, and the railroads were just the laboratory. The real test of Morgan's system was coming. In 1900, one man dominated American steel, Andrew Carnegie. His mills produced more steel than all of Great Britain combined. His costs were the lowest in the industry. His competitors were not just losing, they were being systematically destroyed by Carnegie's relentless efficiency. Carnegie was 65 years old when the new century began. He had spent decades building his empire through vertical integration, controlling everything from the iron ore mines to the blast furnaces to the railroads that shipped the finished product. No one could match his scale. No one could match his costs. But Carnegie was thinking about something else now. Legacy. He wanted to give his fortune away. Libraries, universities, concert halls. He called it the gospel of wealth. The idea that the rich had an obligation to distribute their money for the public good before they died. To do that, he needed to sell. Carnegie Steel was so large that only a handful of buyers in the world could afford it. Morgan had spent the previous year watching his own steel investments struggle. The Federal Steel Company, which Morgan had organized in 1898, was losing market share to Carnegie at every quarter. National Steel and American Steel and Wire, other Morgan-backed ventures, faced the same problem. Carnegie's efficiency was crushing them. Something had to change. And in January 1901, Morgan made his move. Carnegie's intermediary was Charles Schwab, the president of Carnegie Steel. Later accounts say Carnegie wrote his asking price on a scrap of paper and handed it to Schwab, who delivered it to Morgan the next day. Morgan reportedly glanced at the number, $480 million for Carnegie's personal stake, and replied simply that he accepted. The story became Wall Street folklore. The handshake deal, the napkin negotiation, the two titans settling the fate of American industry over lunch. What's not folklore is the E-scale. $480 million for Carnegie alone. The total transaction, including all shareholders and bondholders, created a corporation capitalized at $1.4 billion, the first billion-dollar company in American history. United States Steel combined Carnegie Steel, Federal Steel, National Steel, American Steel and Wire, and several other producers into a single entity. When it was finished, United States Steel controlled approximately 2/3 of American steel production. Morgan's syndicate collected tens of millions in fees for organizing the merger. But the significance went beyond the numbers. Morgan had demonstrated that industrial consolidation could happen at a scale no one had previously imagined. If you could merge an entire industry, if you could bring competitors together under coordinated control, you could eliminate the destructive competition that terrified investors and destabilized markets. This was the machinery of Morgan's power. Railroads had been the first laboratory. steel proved the model could scale to any industry. And by 1907, Morgan's influence extended across American capitalism. Banking, railroads, steel, electrical equipment through General Electric, which Morgan had helped create in 1892, agricultural machinery through International Harvester, shipping through the International Mercantile Marine, insurance through connections to the major New York insurers. Congressional investigators would later try to map the scope of this network. They documented 341 directorships connecting Morgan partners and allies to corporations controlling over $22 billion in aggregate resources. That was not wealth Morgan owned. It was influence he controlled through board seats, financing relationships, and the power to coordinate action across dozens of supposedly independent institutions. And then, in October 1907, that entire system faced its ultimate test. The crisis began with copper. A group of speculators led by Augustus Heinze and Charles Morse had been trying to corner the copper market for months. They bought shares in United Copper, driving up the price, planning to squeeze short sellers when the moment was right. In mid-October, the scheme collapsed. The short squeeze failed. United Copper's stock price cratered, and the speculators' failure exposed something dangerous about American finance. Heinze and Morse hadn't just been trading copper. They controlled a network of banks and trust companies across New York. They had borrowed heavily from these institutions to fund their speculation. When the copper scheme failed, depositors at these connected institutions started asking questions. Uncomfortable questions. Questions about where their money actually was. Trust companies were the weak link. These were financial institutions that operated like banks. They took deposits, they made loans, but with crucial differences. Trust companies faced less regulation than national banks. They could engage in riskier investments. And critically, they kept smaller cash reserves. When confidence cracked, trust companies had less cushion to survive a run. On October 21st, the board of the Knickerbocker Trust Company forced its president, Charles Barney, to resign. Barney had been connected to Heinze's copper speculation. The next morning, October 22nd, depositors arrived at Knickerbocker's doors before opening time. A line stretched down the block. Inside, tellers counted out cash as fast as they could. By early afternoon, Knickerbocker suspended operations. $22 million in deposits. Doors closed, lines still growing. The same day, runs began on the Trust Company of America. By October 23rd, deposits at Lincoln Trust had fallen from $21 million to just $6 million. Panic was spreading through the system. Here is what made 1907 different from previous financial crises. America had no central bank. No Federal Reserve existed to inject liquidity into a failing system. No government institution could coordinate a response among competing, frightened financial institutions. The Treasury Department had some tools, but they were limited. Secretary George Cortelyou could deposit government funds in struggling banks, but he couldn't force private institutions to cooperate with each other. He couldn't make bankers trust each other when trust had evaporated. There was only one person in America with the relationships, the credibility, and the will to coordinate a private response to a national crisis. Morgan was 70 years old that October. He was in Richmond, Virginia, attending an Episcopal Church convention when news of the Knickerbocker failure reached him. He returned to New York on October 19th and established his private library on East 36th Street as the command center for the response. For the next 2 weeks, Morgan worked to prevent a complete collapse. He met with bank presidents. He examined balance sheets. He made rapid judgments about which institutions could be saved and which were beyond rescue. He organized emergency loans to keep the Trust Company of America open, even as depositors lined up daily to withdraw their money. He persuaded the strongest banks to support the weakest. He brought together competitors who normally refused to speak to each other. He used his reputation, the accumulated weight of 40 years of deals to convince frightened bankers that if they acted together, they could survive. But by early November, the trust companies were still hemorrhaging deposits. Morgan needed a permanent solution, one that would require the trust company presidents themselves to commit their own capital to a common rescue fund. They did not want to. Each president looked at his own institution's problems and calculated that he might survive even if his competitors failed. The incentive was to hold back, to preserve capital, to let someone else take the risk. On Sunday, November 3rd, Morgan summoned them to his library. The trust company presidents arrived expecting a meeting. They got something closer to captivity. Morgan's library was designed for intimidation. Red silk walls, Renaissance paintings, rare manuscripts in glass cases. A massive desk where Morgan sat, surrounded by his partners, facing the assembled presidents. When everyone had arrived, Morgan quietly had the front doors locked. His message was simple: no one leaves until you agree to pledge enough capital to stop this panic. The trust companies would save themselves together, or they would fail together. There was no individual escape. The negotiations continued through the night. Some presidents resisted. They argued that their institutions were sound, that they should not have to bail out competitors who had been reckless. Morgan applied pressure. He made clear which institutions would receive continued support from his network and which would be allowed to fail if they did not cooperate. The hours passed. Midnight, 1 in the morning, 2, 3. Finally, at 4 in the morning, Morgan had his agreement. The trust company presidents pledged $8.25 million to a common fund. The doors were unlocked. Dawn was breaking over Manhattan. Over the following days, confidence slowly returned. The bank run stopped. Depositors who had lined up to withdraw their savings started leaving their money in place. The acute phase of the panic was over. Morgan had done what no government institution could do. He had functioned as the private lender of last resort for the entire American financial system. One man, working from his personal library, had stabilized an economy because he controlled enough relationships across enough institutions to coordinate a response. But even as bankers praised him, a question emerged that would reshape American finance forever. What happens when one private citizen has this much control over the financial stability of an entire nation? What happens when that person gets old, or gets sick, or simply decides not to help? The panic of 1907 triggered a reform movement that Morgan himself could not stop. In 1908, Congress passed the Aldrich-Vreeland Act, creating a mechanism for emergency currency issuance during future crises. It was a temporary patch. The real debate was just beginning. For the next 5 years, reformers argued about what kind of central banking system America needed. Should it be fully public, partially private, centralized in New York, or distributed across the country? The debates were technical, but the underlying question was simple. Should the stability of the American economy depend on the goodwill of one elderly banker? In 1912, the House of Representatives convened a special committee to investigate. Led by Louisiana Congressman Arsène Pujol, the committee examined what they called the money trust, the concentration of financial power in a small group of New York bankers. Morgan was called to testify in December 1912. He was 75 years old and in declining health. His skin had the pallor of a man who did not have long to live, but his mind remained sharp, and he sparred with the committee's counsel, Samuel Untermeyer, for 2 days. The exchange that everyone remembered came when Untermeyer asked whether Morgan controlled credit in America. Morgan replied immediately, "No, sir, I do not," Untermeyer pressed, what then determined whether Morgan would extend credit to someone. Morgan's answer became famous. The first thing is character. The Pujol Committee's final report painted a different picture. They documented 341 directorships held by Morgan partners and allies in 112 corporations. They calculated that these connected institutions controlled resources exceeding $22 billion. The committee concluded that a small group of financiers had achieved, in their words, a great and rapidly growing concentration of the control of money and credit. Morgan did not live to see the consequences of their report. He died in Rome in March 1913, 3 months after his testimony. He was 75 years old. 9 months later, in December 1913, Congress passed the Federal Reserve Act. For the first time in its history, America had a central bank. A government institution could do what Morgan had done privately in 1907. Inject liquidity into a panicking system, coordinate responses among banks, and function as the lender of last resort. The architecture of American finance was being rebuilt on public foundations. The Morgan Empire did not disappear, but it divided. The Glass-Steagall Act of 1933, passed in response to the Great Depression, forced a separation between commercial banking and investment banking. J.P. Morgan and Company had to choose. It split into 2 entities, the commercial bank that became J.P. Morgan Chase and the investment bank Morgan Stanley. The names survive today. The concentration of power that existed in one man's library does not. The executive lesson is this: Morgan demonstrated that private coordination could substitute for public institutions for a time. In a crisis, one man's relationships, one man's reputation, one man's willingness to lock bankers in a room until they agreed to cooperate, that could stabilize an entire economy. But the same demonstration revealed a fatal fragility. A system that depends on one individual's judgment, health, and willingness to act is not a system at all. It is a person, and persons die. Morgan built influence rather than wealth. He controlled systems rather than assets. And when he died, the architecture of American finance had to find a new foundation. The institutions we recognize today, the Federal Reserve, the separation of commercial and investment banking, the regulation of financial concentration, exist because one banker's extraordinary power revealed what happens when private control operates without public accountability. That is the story of J.P. Morgan, not the richest man in the room, the man who controlled the room itself.